Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Equinix Incorporated, ticker EQIX. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, this company has a market cap of $63.5 billion, enterprise value of $73.5 billion. So you can see about $10 billion in net debt on this business. Means that the debt is about 16% of the overall enterprise value. Not a huge amount of leverage, but it's a decent amount overall. This is an equity real estate investment trust or a REIT, so we know that they're going to be focused on real estate investing. See if the business description tells us more. They are a digital infrastructure company, so a little bit different than your standard REIT. Enables digital leaders to harness a trusted platform, bring together internet foundational infrastructure. Let's see. They launched digital services. This is a very weak business description, so it doesn't really tell me much about what they're doing. Maybe they're having data servers or something like that. But they're because it's a REIT, you know that they're renting out some portion of their business. And so that's what I'm going to guess is some sort of computational infrastructure. Beta is 0.53. That's actually quite low. It means you're going to be about half the volatility of your average S&P 500 company, which is a pretty good sign. The lower the beta, it tends to be a sign of a potential good business. So I like that when I see it, but it's not a be-all, end-all. Now, the return on invested capital chart is where I start to become concerned. Now, we see what looks like probably startup costs starting in 2002. So you have losses for 1, 2, 3, 4, 5, 6 straight years. I'm going to ignore that because after that, you have much better returns. And if you start at 2008, once they started to turn a profit, they turn a profit in every year except one in 2014. So I tend to forgive that. Now, we are going to dive into 2014 to really understand, is that a real loss or not? Because it looks like in general, this company is making a profit each and every year. That tends to be a really good sign for a quality business. Now, what I don't like is that the return on invested capital numbers are quite low. You see 5% in 2008 and then 2% in 2021. They've really not gone above 2% since basically 2008. I mean, 2009, 2.9% here, 2.6%, 2.3%, 2.5%, 2%. These are really, really low return on invested capital numbers. Even with leverage, you're going to struggle to get double-digit returns on equity when you have numbers like that. Because if your interest rates that you pay on your debt are higher than the return on invested capital, then you're not really creating a lot of value for shareholders. And that tends to be a major concern for me in the long term. Now, let's dive on into some of these. You see these median returns here. You know, they're turning that 1.8% return on invested capital into 4.4% return on equity. This is what I mean. Like 4.4% return on equity is really going to cap your total return capability as a shareholder. You're not going to get a return higher than return on equity over a long period of time if you hold the stock for a long period of time. What this sort of return on equity means is you're really talking about some sort of speculative investment. If you can buy at the right time and sell at the right time, this can be very, very profitable, especially when you see growth like this. It's often possible that with 15% revenue growth, 12% EPS growth, you can see some very good returns as a shareholder when you can find a good time to speculate in it. However, the price is just so high. I mean, price to sales ratio of 9, price to earnings ratio of 91. You're never going to make a profit as a shareholder if you're buying at a PE of 91, even on a speculation, because the standard thing is for your multiple to decline over time. I mean, price to sales of 9, EV to sales of 10. These are just extremely high prices, and yet the business looks poor. I mean, your business quality here is 4.5%. I really like to buy this when it's 15%, so more than triple the current price. I just see return on invested capital of over 10%, more than 5 times the current price. You also see assets growing faster than revenue, assets growing faster than EPS. That's going to worsen your return on invested capital over time. So I don't like it when I see that setup either. So we have some major, major concerns as I look at this setup. Now, let's look briefly about these numbers down here. I want to look at this 2014 number where we seem to have had a loss. Now, what's weird here is from 2013 to 2014, you grew revenue by 13%. You grew your gross profit by about 20%. You grew your operating profit by over 10%. So why is it that you have this big EPS loss? And I'm going to guess that it is some sort of one-time effect because it doesn't look like a real number there. And so that would have me concerned. Now, what's interesting here is if we look at this, we take this PE of 5, right? or this earnings of $5. You look at the current share price of 686. That means this PE ratio actually overstates the PE. I mean, the true PE here is something like 110, 120, 130. If you just take it on this 2021 number, I mean, these are astronomical numbers. I mean, maybe if you take this 2019 number, you could say $6. But either way, you're in that range of 100 times PE. This isn't an overstated PE ratio. This company is massively, massively overvalued. Even if it was a high-quality company, I would never pay a price nearing 100 times PE. Something over PE of 30 is way too much for a company like this, which means this company needs to drop by about 2/3 in the price before it even gets to the overvalued territory. Right now, it's just extremely overpriced. From what I can see here. If you're enjoying this video, if you're learning something, please hit that like button. I need you to hit that like. The long-term viewers, hit those likes in every video. That really lets YouTube know you're enjoying my content, so please give that a go. Now let's go to the income statement here. Go back immediately 2014, and we can see the big thing here is income tax. So you can see they had a pre-tax income pre-tax profit, which is what I'm really concerned about. And you can see that that number was profitable even with some one-time numbers. So I'm not really concerned about this income tax rate. You can see it's much larger than these other years. It could be related to some piece of the real estate investment industry. It doesn't really matter. It just lets you know that I would ignore that and just say this company's been profitable every year since 2008 is what I'm learning from that. Now, one thing that you can see that is pretty obvious with a company like this is just massive dilution. You can't grow at a rate like this, 15%, 12%, that's much higher than your return on invested capital, return on equity over time, unless you dilute shareholders, and they're massively diluting shareholders and taking on new debt. You can see them basically doubling their share count over the course of the last decade. That's a significant amount of new shares and basically just destroys returns for shareholders over time. That's why you see the net income grow by 4 or 5x over the course of the decade, but your EPS only doubles or triples, and it's because they're diluting you over that time period. Let's look at our balance sheet. Let's see. I'm going to assume there's going to be a much more debt, and you can see that they've basically more than 4x, almost 4 to 5x their debt over the course of the last decade, which is a big concern. I mean, you've gone from $2.3 billion in debt to $11 billion in debt, $11.5 billion debt. You've gone from $5.5 billion to $27 billion in assets, 5 extra PP&E. I mean, the problem is like, yes, you're growing your assets so fast that it's earning. I mean, even though you had amazing growth, 140 million to 700 million, 4x, you've more than 5x your assets to do that. So you're getting worse and worse returns over time. I mean, that's why that even though you have on this chart here, this nice number in 2008, 2009, these numbers have gotten worse over time. You're barely hovering at 2% when you were in the high 2s and 5% because you're getting worse and worse returns. That's really a bad setup for you as a shareholder. You can see the constant investment here in PP&E, oftentimes exceeding your cash flow from operations. That leaves no money for paying dividends, and yet because they're a REIT, they have to pay dividends. It's looking like, if I read this right, probably the conversion to a REIT was what happened in 2014, which is why you're getting this starting to pay dividends. But you didn't beforehand. That might be why we see that there. But you can see all these dividends are being funded by debt and share buybacks. They have no free cash flow. If you subtract cash from investing from cash flow from operations, there's no money there to pay dividends. The only way they can do it is if they can bring on new shareholders and bring on new debt. You can't do that forever. You can certainly bring on new shareholders forever, but you can't bring on new debt forever. Either way, this is going to be a major problem as interest rates rise. If your interest rates that you're paying on your total debt exceed the return of your assets, you're in trouble. The company's going to start losing money and losing money significantly, and that's a major problem for you as a potential shareholder. So this is exactly the type of setup I would avoid as an investor. You're not going to get attractive returns in the future when you have these sorts of returns. Can you get good returns from this business? Maybe, but it will require higher returns on assets than you've had in the past. It will require a change in capital allocation. It will require a lot of changes in how this business is being run. I don't bet on change. I bet on things being the same. So for me, I'm avoiding Equinix, ticker EQIX. If you enjoyed this video, please hit that like button. Don't forget to subscribe. At the top, I do have a link to all of the companies that have passed my test and gotten onto my watch list from the S&P 500. It's over 30 companies that I believe are worth looking at in the S&P 500. I hope you'll check out that playlist. And if you enjoyed learning from this software, consider using the link in the description below to quickfs.net. The first link there is my affiliate link. If you sign up using that link to a free or paid account, I can receive a commission for sending you there. That's a great way to support the channel. Again, you don't have to pay anything to do it. You can get a free account and check out this software that I use to analyze companies. Thank you for listening. And until next time, stop paying fees, start building wealth.